Good afternoon, everyone. My name is Michael Naidrich. We have our head of rates, all things liquidity in the Fed, CFA Gregory Faranello, but also we have Devin Banerjee, senior editor at LinkedIn, where he oversees original reporting and curation of financial services news and views of the 720 million global members. Devin was previously an editor and reporter at Bloomberg, where he covered investment management before overseeing coverage of M&A and the private equity industry. He's an honors graduate of Stanford University and holds a CFA designation himself. Lead us out and run through the dynamics from the last meeting of December 2020 and where we are headed into this week's meeting.
I would say the biggest thing that came out of the December meeting, the final meeting of 2020, was the Fed actually linking their asset purchase program to outcome-based forward guidance, similar to what they had done with interest rates in September. Right. So following that, we moved into year end. We obviously had the fiscal package that was past $900 billion. We went very quickly into the Georgia Senate runoff. And then right alongside that, at the same time, we did get some talk of bond tapering by a few select Fed members, which took the long end of the yield curve back to levels that we hadn't seen since March of 2020.
Yeah. Hey, Greg, if you can touch on, there's been a pretty big, decent repricing of the long end of the U.S. Treasury curve as recited in your recent white paper. What are your thoughts of the repricing, and what do you expect the Fed to address this in this week's meeting?
So when you go back to 2020, probably one of the biggest things that came out of 2020 was the Fed actually changing their policy framework to an asymmetric bias, right? So now looking at inflation, not on a preemptive basis, but letting inflation at least meeting 2% and average and running above 2% for quite some time. And when looking at the employment side of the equation now, looking at shortfalls, not deviations in employment, a broad-based and inclusive policy mandate. So if you look at 10-year rates, when we reopened the economy in June of 2020, rising COVID cases, we bottomed out in the summer of 2020 with 10 years hitting 50 basis points. And we've really trended higher ever since then, with inflation expectations running considerably higher since the Fed announced their asset purchase program in March of 2020.
I'd like to bring Devin into this with you, Greg, and maybe you can take a shot at it first, Greg, and then maybe we can throw it over to Devin. You know, I think the new buzzword here is the K-shaped recovery. What are you both hearing from the Fed? And Dev, I'd like to hear some of your high-level data and trends that we're seeing in the labor market.
Sure, I'll just start off. I mean, if you listen to Fed Governor Brainard in a speech this month, she talked specifically about the K-shaped recovery. If you look at incoming Treasury Secretary Yellen, she's talking very explicitly about the K-shaped recovery. Through the Fed Listens program, the Fed was already headed in this direction, going around the country to try and gather up information in communities to see really where the structural problems are in the job market. And I think that's been exacerbated by COVID.
And this is absolutely something, Mike, that we see discussed on the LinkedIn platform across the board. I mean, with my vantage point, I can see what people are talking about, what topics are trending across 722 million folks on the platform, different industries, different job titles, different geographies. And we actually have started a bi-weekly pulse. It's actually a statistically significant survey that we run with an N size north of 5,000 every 2 weeks in different geographies. It's called our Workforce Confidence Index. And so a couple takeaways from our most recent edition, which came out 2 weeks ago. We actually have the next edition due out this Thursday. But a couple takeaways. First, some good news. On a trend basis, financial confidence among, and this is in the US, so financial confidence among Americans is ticking upward on an absolute number. It's not that high yet, but directionally it's ticking upward. Last April of 2020, when we ran the survey, only about 11% of Americans expected their personal financial condition to improve over the coming 6 months. In October, that was up to 28% from 11%, but maybe some seasonal factors around October. In January, on January 1st, it was at 32%. Again, expecting their income to rise over the next 6 months. That optimism is particularly strong, Mike, among millennials right now. About 41% of them are anticipating that income bump going forward. Now, of course, the question for investors and for policymakers is, what will people do with this money, right? Are they going to spend it? Are they going to save it? What have you? You know, last year we saw incomes kind of propped up with government support, but we did see consumer spending kind of collapse, and the Fed data showed also that the saving rate soared. So according to our data, the Workforce Confidence Index, about 36% of Americans expect to boost their personal savings over the next 6 months. And we asked them, are you going to increase, stay the same, or decrease? So this is kind of on a negative 100 to 100 scale. So about positive 36% do expect them to save. So that trend is probably going to continue with saving. And unfortunately, I would say unfortunately, on the spending side, only about 14% expect to step up their spending. That's only slightly up from 12% last July.
Greg here is kind of maybe look forward and see what we're going to expect on Wednesday. Talk about, you dive into the post announcement where there's a lot of information within the information. How you seeing it for this Wednesday?
Yeah, so Mike, we don't see any demonstrative changes coming from the Fed on Wednesday. So if you listen to Powell, and Powell was a member of that Fed back in 2013, so I think it's pretty sensitive to him. If you listen to a WebEx that he had on the 14th, he's pretty adamant here the Fed's going to stay the course. So I do expect a little bit of Q&A back and forth in terms of what the Fed's intentions are. And certainly if the economy does continue to improve and we do start to see a continued uptick in inflation expectations and an actual headline inflation, I think certainly the dialogue with the Fed can change as we move further along this year. But I think right now the Fed is really entrenched, especially when you look at the job numbers of late, which have come down. And you certainly, if you look at what COVID's doing on a global basis, we think the Fed is going to continue to be very dovish here.
Devin, you seeing it the same?
Yeah, I
exact
would just
way?
say more qualitatively, Mike, one thing about this Fed chair, which you guys know more than anybody, is he's been very vocal about this bifurcation that you alluded to, Mike, and very vocal about how different pockets of the country, pockets of society are experiencing these economic conditions right now. And so I'm going to be listening very closely to more on that, and also any other nuances in the data that comes out this week in terms of different industries, et cetera. Some of our data that we're looking at, for example, shows a bifurcation in industry confidence right now as well, and in job functions, et cetera. We see HR professionals, legal services, staffing and recruiting professionals gaining a lot of confidence, which is a good sign, hopefully, for the job market in terms of hiring activity going forward. We're also seeing airlines and aviation's professionals on the platform really uptick in confidence on an absolute basis, not a high number, but trending upward. And then at the bottom of the spectrum, we see, of course, restaurants, utilities, and other professionals that it's not surprising are still struggling.
I was on a Zoom at the end of last week with someone who had recently had a conversation with Chairman Powell. And, paraphrasing a little bit, but, Chairman Powell's words to him was, this economy in the U.S. is really in good shape. And what is sort of your thoughts on that statement?
Yeah, so I think if you listen really specifically to Powell, one thing I've said to clients in terms of forward guidance, right? We know this mandate of maximum employment, full employment. What does it really mean? We see inflation ticking up. When Powell speaks very specifically, he speaks back to the beginning of 2020. He consistently references that time period where he thought the economy was really strong, and in particular, the job market was very strong. So we had an unemployment rate around 3.5% to 4%, and he's been pretty adamant that that's when they were really starting to see that unemployment rate trickle down to some of these lower income communities. So the bottom line there is the underpinnings, I think, of this economy before COVID hit was very, very strong.
Yeah, I've certainly heard that as well in my conversations with investors. I as you guys know, I try to interview some of the larger names in the investing landscape, and I had a conversation recently with David Rubenstein, the billionaire co-founder of the Carlyle Group, and he certainly agrees with what Greg and Chairman Powell, who we actually hired at Carlyle years ago, have said. But taking an even larger step back, what some of these people are really optimistic about are the changes that this period has necessitated, especially the technological innovation that has occurred across industries, and a lot of that, people think, and I'm sure you guys agree, will stick with us going forward. And you keep hearing this line that digital adoption and the digitization of this economy has accelerated what it would have over 5 years has done so in 1 year. And so I think that will continue driving this economy as well after this period.
Other than that, we hope for continued safety for all of our clients, friends, and family, and we wish everyone a nice day.